Hello, I'm Ron Parisi with CPA on Fire. I'm joined by CPA on Fire's very famous tax director, Andrew Hawkins, CPA. We're together today. We just wrapped up 2025. It's beginning of January. I thought it'd be a good time to explore what was going on in 25, particularly at the end of the year during the tax planning meetings with our private clients at CPA on Fire. We do a lot of tax strategy. We do tax planning for business owners, founders, visionaries. So Andrew, how are you doing, first of all?
Doing great. Wrapped up a great year. Very active, a lot of changes that came through. So a lot of new planning opportunities, which is the main point of having a constant communication with your CPA, having that ongoing relationship just to be able to evolve and make those micro pivots that we always talk about during the year in order to capitalize on everything that changed this past year. So whether it was the market, the businesses as a whole, or the new tax law changes, there was a lot to adjust for this year, and we're able to execute on a significant amount of tax planning opportunities for our clients. Felt like it ended the year strong. We've got a little bit of a slower period, but about to ramp up into 2025 tax season.
Yeah, I was say in summary, 2025 was kind of a lot happened in 2025, right? We started off with a lot of economic uncertainty with the tariffs coming down, stock market, unbelievable returns, commodity, gold, silver, all-time highs, crypto sort of came down unexpectedly I think from everybody. So I think at least from my side with our clients, there was a lot of uncertainty, and I think overall 25 was a very positive year for most of our clients, and it was very uncertain. So let's flip over to the tax strategy piece and the planning piece. Like maybe, let's talk about maybe the top 3 observations, topics that you explored with our clients. This way, folks can really get on top of what exactly happened, during the tax planning process here.
Yeah, there's a lot that we can dive into because, as everybody knows, in July of this year, brand new tax laws were put out. There was a lot of negotiating, a lot of uncertainty as far as exactly what that would look like. But thankfully, the One Big Beautiful Bill addressed just about every topic that we had prepared for. And we were able to pull back on an initial, my least favorite message to convey at the early part of 2025, which was we had a lot of sunsetting provisions that were going to increase taxes for business owners. And we were prepping for larger tax payments and more advanced strategies to reduce that number. And so thankfully the bill was passed in July, and that comes with a lot of opportunity, but a lot of compliance changes. The IRS needs to issue guidance on it. So we were in a little bit of a Wild West period between we know what the tax law says, we need to wait for the IRS to interpret and provide guidance on exactly how to execute on things. So it was very entertaining, to say the least. A lot more in-depth conversations with clients, multiple year-end meetings just to make sure we accomplished everything that's available to each business owner. But a couple of the key categories that I saw being the most pressing topics from the new tax law changes. The first of which, and applies to just about every single business owner out there that's developing products, improving internal processes or software, things like that, was the change in Section 174 research and development credits, which was a relatively new and impactful, it's only been in place for about the past 3 to 4 years of this treatment, where if you take the R&D credit, then you've got to amortize and defer the expenses that you're able to write off on your business income over a 5 to 15 year period. And the One Big Beautiful Bill completely reverted that back to pre-2022 treatment, where business owners are able to take the full amount of expenses and get the R&D credit if they've got domestically based research and development expenses that qualify. So we saw some hesitancy prior to this new bill being passed, where people would kind of make the trade-off or determine how vigorously they wanted to pursue the credit because of that deferral of expenses and higher tax bill that would kind of offset some of the credit itself. But now that's been completely revamped. For any domestically based expenses, you're able to pursue the full R&D credit and the full expensing in the year that actually occurred. So there's a lot less of a timing difference for expenses. You're able to write off the full amount against taxable income this year and get the credit for a significant portion of research and development expenses and keep more cash in their pocket this year. We're having a lot more consultations with our specialists, with our research and development firm, and I think a lot that we can capitalize on this year. And make sure everybody that has it available to them is taking advantage of it. So R&D was probably the most common topic that strayed from the typical year-end process, but there's still improvements such as QBI optimization and that deduction on any pass-through income for S corporation owners.
I was saying before we jump topics, just to wrap up, I think R&D. I kind of relate it to a traffic light, right? After the changes in 22, it was kind of a yellow light, right? Whether our clients really wanted to pursue it 100%, because just in general terms, you had to take a hit to have a long-term benefit. But after the One Beautiful Bill this summer, I think it's complete green light. I mean, if you spend any money developing software, developing an app, developing some type of unique process and procedure inside the four walls, it's a green light. I mean, this is, free money, essentially, not necessarily free money, but this is a big time credit that you could be taking advantage of if you're a business owner. So great.
Yeah.
Okay. So second topic is QBI or some other changes as well inside the Beautiful Bill.
Yeah. So for the One Big Beautiful Bill specifically, the other key topics that'll affect business owners the most is, I would say, the state and local tax deduction as well. So that was increased from $10,000 up to $40,000 for anyone filing a joint return with their spouse.
That's the famous salt limitation, right?
Exactly. So that's been a relatively new concept as well. I mean, it was 8-9 years ago that it was implemented, where you weren't able to fully deduct any state tax payments that were made. And that was limited to $10,000, which in higher taxation jurisdictions for higher earning individuals, you were missing out on a significant amount of tax deductions on your federal return. And we saw a lot of states create a backdoor method there called the PTE election, PTE tax payments, as a way to kind of circumvent that limitation. But what we saw with this new tax bill is they quadrupled the amount that you're able to deduct. But it's anything under $500,000 of total adjusted gross income, you get the full deductible amount. Anything above that, it slowly gets phased out for you as well. But it reverts back down to a minimum of $1,000 of state and local tax deduction. So you'll still get that same amount no matter what, but there's a lot less need for these backdoor methods, the overly complex routes in order to separate the business tax payments from the individual, and will simplify a lot of the compliance requirements for individuals and make sure you're getting much higher write-off of your state taxes as well. So even if you're just a high earning individual, full-time employment with the company, that'll be a huge increase in the amount of deductions you can take if you itemize deductions on your return. So that'll apply to a lot of the population, a lot of business owners as well, and hopefully simplify things moving forward for them. Yeah,
I was going to say, I think that's a huge, like we saw in California with the PTE, so complex, right? Why do taxes need to be so complex? The $40,000 limit will eliminate a lot of that additional complexity on our clients that we had to kind of walk them through. I think that's a win-win round. And lastly, I mean, this is, I think, the most underplayed topic, the qualified small business. Maybe talk a little about that, talk a little about the changes. I think this is the one that really raises eyebrows, because particularly with our clients, the $2 to $5 to $10 million businesses who are looking to eventually have an exit. This is real tax planning, real long-term strategy. So I'll give you the talking stick here.
Yeah, no, you nailed it head on. It's long-term tax strategy focused. And it's one of those scenarios where taking the most immediate tax deduction or 1 year worth of tax savings can actually hurt you in the long run. And the reason I say that is because QSBS is, I don't like the term tax loophole. I think everything's incentivized behavior for one reason or another, but it's as close as you get to one. And it's really evolved around exit planning for individuals whenever you want to divest from your entity or sell a portion to another additional investor, anything like that. That's where entity structure is going to play a huge key role in the lifetime taxation of your business and for you as an individual. And it really pivots on its head what entity structure is correct for you today and over the next 5-10 years. So it's really important to have a long-term tax strategy as opposed to how do we just minimize 2025's taxes to the lowest amount, because that'll bring you to a different answer and you'll leave a lot on the table. So the big changes for QSBS from the new tax law is that what is typically a $10 million exclusion of any capital gains generated from the sale of a C corporation stock. Obviously, there are a couple of initial qualifying characteristics, but assuming all of those are met, you can exclude 10 million or 10x your basis of the sale of originally issued C corporation stock if you hold it for a 5-year period. And that was the original tax law. That's what's been in place prior to 2025. They completely revamped it this year on a couple of different key components. The first of which is they increased that exclusion to 15 million. So if you've got a 24% effective tax rate on a future sale, any large capital gains, at that point, we're talking multiple millions in excluded or saved taxes upon a future divesting from that entity or sale in that case. And so on top of the $15 million exclusion going up from 10 million, there's also a graduated holding period that will allow you to take advantage of QSBS on a prorated scale if you hold it for less than 5 years. So for any newly formed C corporations after the bill was passed, so after July 4th of 2025, you've got a 3-year holding period requirement in order to exclude 50% of all of the capital gains from that sale, or a 4-year holding period for 75% exclusion, and then the same 5-year holding period to reach a full 100% exclusion of any proceeds from that sale. It allows you to take advantage of it without having to commit to the full 5-year engagement or 5-year holding period. Because a lot of these transactions come up, very quickly, and they want to close very quickly, and you got to capitalize on the opportunity. So it gives you a little bit more flexibility to reap some of the benefits. It's not necessarily an all or nothing commitment, where if you sold it at 4 years and 10 months or 11 months, you'd get none of the benefit there, and you had to reach that 5-year holding period. Now it's a graduated scale that allow you to take 50, 75, all the way up to 100%, depending on the holding period. So a lot more flexibility, a lot more opportunity to capitalize on it. And it's becoming a bigger and bigger part of our conversations on, we'll see in the original entity structure being a single member LLC or an S Corp, those can provide a lot of tax savings over a 1 to 2 year period, but they get very dwarfed when you consider the exit planning down the line, with QSBS being a qualified event there. So It's very important to take a step back, take a longer approach, bigger picture approach to your tax planning, just so you're not leaving millions on the table, paying it into the IRS upon a future sale. So very important topic. Becomes one of the most important for any owners or entrepreneurs that are looking to sell their company down the line or just want to be positioned to capitalize on that in the future. We're talking about that with just about every business owner at this point.
Yeah, I was just going to add, I think we'll do another podcast just on that topic. But two things, right? One is how many times as a prospect, one is we work with transformational clients, right? Transformational businesses, right? Fast growing businesses. How many times do people come to us as a prospect and say, I formed my company and I automatically, chose the S Corp because that's what my corporate filing agent told me to do, right? And you're like, yeah, dang, dude, we have to work our way out of that, right? If we really want to take advantage of that. And then two, just, you built an incredible piece of software, right? That really, has a lot of different ability to put inputs in and to really see what that QSBS savings looks like. Mm-hmm. We just ran through one recently, right? The savings was in excess of $3.5 million. So these are, and that was, I think over the full period of 5 years, but you're talking, like you mentioned, millions of dollars upon exit. And even if it's a short-term 3-year holding period. So I think it's something you definitely kind of need to come in with your eyes wide open.
Yeah, absolutely. We've seen a lot of scenarios where exactly what you described, an entrepreneur will come in, have a very successful first year or two with the company, want to consider switching to an S Corp. And if we just looked at that picture alone, you're right, they could save 20, 30, 40,000 by switching to an S Corp. But what you're leaving on the table when you expand that view to 3 to 5 years down the line, it becomes a very clear decision that they need to make. And it does require a little bit additional taxes, higher effective tax rate in those operating years leading up to the exit. And that's the picture we want to paint for clients, is make sure they have all the information available to make the best decision for them. And we still have some that just, say, I want to keep doing this into retirement. I never want to sell, and then we can table that decision for a later date. But most of the time, once we input into the software, run the calculations and projections for them, it's hard to pass up on that type of savings. It just, most individuals don't know is available to them. It's not talked about enough, but hopefully that changes now that they've got the expanded rules and qualifications for it.
Yeah, I think, I mean, the one caveat is it's just not as easy as being like, well, I want to take advantage of, I'm going to be an S, or I'm going to be a C Corp. Like, this takes like intentional planning. Takes just like anything with the IRS, there has to be an intentionality about it. So I mean, definitely seek a qualified professional before you just jump in. Anyway, pleasure always being with you, Andrew. We'll call it a day there, and appreciate it. Look forward to seeing what 2026 has in store for us. Thank you.
Yep, it'll be a great year. Thanks for your time, Ron.
I appreciate it.